The Intelligent Investor by Benjamin Graham. Summarized by Audiobook Power. Unlock your potential with Audiobook Power. Subscribe now for the keys to success and inspiration. Benjamin Graham's The Intelligent Investor, first published in 1949, is widely regarded as the definitive guide to value investing. Known as the father of value investing, Graham emphasizes principles of long-term investing, risk management, and emotional discipline. Updated over the years, the book's timeless lessons continue to resonate with investors seeking to build wealth intelligently and sustainably. Core principles of the book. 1. Investing versus speculating. Graham distinguishes between investing and speculating. Investing, thoroughly analyzing a stock's fundamentals, ensuring safety of principal, and seeking a satisfactory return. Speculating, making decisions based on market trends, rumors, or short-term gains. Key insight: an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. 2. The concept of intrinsic value. Intrinsic value is the true worth of an asset, determined through fundamental analysis. Successful investing involves buying assets when their market price is significantly below their intrinsic value. Example: if a company's intrinsic value is $100 per share and it's trading at $70, the stock is undervalued and presents a margin of safety. 3. Margin of safety. The margin of safety is the difference between an asset's intrinsic value and its market price. Graham emphasizes that a wide margin of safety minimizes downside risk and protects investors from unforeseen events. Key insight: the margin of safety is always dependent on the price paid. It will be large at one price, small at some higher price, non-existent at some still higher price. Key lessons and strategies. 1. The defensive versus enterprising investor. Graham categorizes investors into two types. Defensive investors seek safety, simplicity, and stability. They prefer low-risk investments like diversified index funds or bonds. Enterprising investors are willing to devote time and effort to research undervalued stocks or special opportunities. Key takeaway: determine your investment style based on your time, expertise, and risk tolerance. Chapter 2. The Mr. Market Analogy. Graham introduces Mr. Market, a metaphorical character representing the stock market's irrational behavior. Mr. Market's mood swings create opportunities for investors to buy undervalued assets or sell overpriced ones. Lesson: avoid following the crowd and capitalize on market volatility instead. 3. Dollar cost averaging. This strategy involves investing a fixed amount at regular intervals, regardless of market conditions. It reduces the risk of mistiming the market and allows investors to buy more shares when prices are low. Example: investing $500 monthly in an index fund ensures steady contributions and avoids emotional decision-making. 4. Avoiding common pitfalls. Graham identifies emotional biases and speculative behavior as major pitfalls. He urges investors to avoid chasing trends or hot stocks. Focus on long-term goals. Remain disciplined during market highs and lows. Key quote: the investor's chief problem, and even his worst enemy, is likely to be himself. The importance of dividends. Graham advocates for investing in companies with a consistent history of paying dividends. Dividends provide a steady income stream and reflect a company's financial stability. Key insight: dividends can act as a cushion during bear markets and enhance total returns over time. Applications in modern investing. 1. Index fund investing. For defensive investors, low-cost index funds align with Graham's principles of diversification and minimizing risk. 2. Value investing. Enterprising investors can apply Graham's methods to identify undervalued stocks through fundamental analysis. 3. Risk management. Maintain a margin of safety and diversify across asset classes to reduce portfolio volatility. The timelessness of Graham's advice. Emotional discipline. Successful investing requires detachment from market hysteria. Long-term focus. Patience and consistency yield better results than chasing short-term gains. Continuous learning. Understanding financial statements and market dynamics empowers better decision-making. Key. Quote, "To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks." Critiques and considerations. While Graham's principles remain relevant, some argue that modern markets are more efficient, reducing opportunities for individual investors to find undervalued stocks. However, the emphasis on discipline, risk management, and long-term thinking is universally applicable. Conclusion: The Intelligent Investor's Path to Success. Benjamin Graham's The Intelligent Investor is a masterclass in value investing and financial discipline. By focusing on intrinsic value, maintaining a margin of safety, and adopting a long-term perspective, investors can achieve consistent and sustainable success. Whether you're a defensive or enterprising investor, Graham's timeless wisdom offers a blueprint for navigating the complexities of the financial markets. Final takeaway: invest intelligently by focusing on fundamentals, managing risk, and staying disciplined in the face of market fluctuations.